Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, looks like it's 3 p.m. now in New York, so I think we're going to go ahead and get things started. All right, I wanted to welcome everyone to this afternoon's ISE webinar. Today's session will be hosted by Jason Ayres, who will be teaching us about trend identification for FX options trading. Jason Ayres is president and founder of OptionSource.net, providing education and opportunities in the stock and options market for over 5 years now. OptionSource.net is one of Canada's leading educators in trading stocks, options, futures, Forex, and commodities. So Jason, if you're with us, I'm going to go ahead and turn it over to you to get things started this afternoon.
Absolutely. Thanks very much, and good afternoon, everybody. Always a pleasure to be working alongside the folks at the ISE. And as mentioned, today we're going to talk about some simple concepts we use to identify trends in the FX options or in the FX market, which of course we can take advantage of utilizing FX options. And those of you that have been following the currency markets over the last couple of days will recognize that we've had some interesting moves. Of course, some talk out of Europe with respect to a Greece bailout has kind of turned the tides a little bit on the U.S. dollar, most noticeably, of course, as it's trading against the euro. And so we want to take a look today at really some of the signs that we can look for in our price charts that will help us make some more effective decisions with respect to certain option strategies. So as we move forward here, just a quick a reminder that the information that we're going to talk about here today is for educational purposes only. In fact, the charts that you're going to see, I actually took this morning, so they're fairly up to date in terms of just some of the observations that we're going to be making. But on that note, I just want to make sure that everybody understands that there are risks involved in that in trading options, and that today's presentation is not meant to be taken as far as recommendations are concerned. So with that in mind, just a reminder as well that there are a number of different products that you can trade that the ISE has put out that gives you exposure to the currency markets. And I think one of the great characteristics of this particular product is the fact that these options are accessible through any standard options broker. So if you have an account with a broker that is options enabled, then you are able to access these particular option contracts. And the nice thing about it is that you can actually trade your views on the currency markets without having to go and open up an FX account with a different broker. The other consideration is that they're of course cash settled in U.S. dollars and European style exercise. So what this means is that they're not settled out with you having to take control of so many U.S. dollars or so many yen or so many euros, but in fact the difference is settled in U.S. dollars cash. And as an option writer, which we're going to talk a little bit about this afternoon, there's no risk of actually being assigned on your options rights early because they're European style exercise. So there's a number of characteristics that make these FX options a very attractive market to utilize, and the market makers work very hard actually at providing a market that is quite liquid and where the spreads are quite attractive for us little retail guys to trade. So with that in mind, as I mentioned, we want to talk about how we can identify certain trends in the FX options market or in the currency market so that we can make better FX options trading decisions. The one thing that I want to reinforce in terms of technical analysis is that there really is no holy grail trading technique. So we look at the whole study of technical analysis as a tool to be used in combination with a sound risk management approach. Now, the great thing about using the options market to trade your currency views is the fact that if you're an option buyer, of course, we have a limited and identifiable risk exposure. So that is one benefit to using the options market as opposed to going into the spot market. But we also always have to consider that if we're not managing those options positions properly, properly, then we run the risk of them expiring worthless as the options buyer. And of course, if we consistently let our options expire worthless as the buyer, well, then we're not going to be in business for long. So we want to find a tool that will help us make more effective decisions and allow us to take action without having to sit back and sort of, debate as to whether or not we should stay with the position or not stay with the position. We can create some rules to follow utilizing some of the techniques that we're talking about here this afternoon. The objective of the technical analyst is, of course, to identify trends as well as identify support and resistance levels. And by doing that, it actually helps us determine, number one, what strategy might be the most appropriate for us to participate in, but also it helps us to determine whether or not we should be considering to take profits or whether or not we're looking at the possibility of a change in a trend so we can take advantage of perhaps entering into a new position. Now, technical analysis and FX options. Well, as the FX options buyer, we can use technical analysis to establish a directional bias by identifying a trend. And the idea is that how do you know whether or not it's appropriate to buy a call or a put option on a particular pair if you don't know what direction, or if you don't have some sort of an inclination as to what direction that particular pair is actually going? The other important consideration is that we can determine very strategic entry points on a particular price chart for the purchase of an option contract. Remember that options are a depreciating asset, so as the option buyer, we always run the risk of that whole time depreciation factor and our anticipated move not taking place within the time frame that we've allocated. So our decisions become very time sensitive. So since technical analysis is used as a way of timing the market, well, then we can sort of make the connection between why it's a very powerful tool to use when we're taking on the role of the options buyer. We can also use technical analysis and, more importantly, support and resistance levels for establishing targets and exits for trade management. The one sort of, I guess, common mistake that I see made with individuals that are really looking to embrace the options market is that they kind of come to the options market with the buy and hold mentality of a stock trader. And the problem with that is that as a stock trader, we can buy shares in a company, we can see those shares appreciate, maybe hit a certain level, pull back a little bit, and kind of do whatever it's going to do. But at the end of the day, we recognize that we can continue to hold those particular shares for as long as we want. But when we use an option contract, we recognize we only have a specific amount of time in order to participate. And so it's important for us to establish some rules that help us manage the position throughout the life cycle of the option contract. So before we actually enter in and, let's say, buy call options on the CDD, which is the U.S. dollar versus the Canadian dollar, we can establish a specific entry point. We can establish a point at which we're going to cut our losses, and we can also establish a point at which we're going to take our profits and manage our position before we actually even commit any capital to the transaction, just by plotting it out on a price chart. And also the whole idea of strike price selection in terms of whether or not we want to use an at the money, in the money, or out of the money option contract, because looking at a price chart, we can identify previous support and resistance levels, previous areas where we've seen the actual pair trade into, and recognize that whether or not there is the possibility of it going there within our within the life cycle of the contract, and then again make an appropriate decision from there. And also, we're going to talk a little bit about debit spreads this afternoon as well, so we can use our price charts to establish some strike prices for appropriate debit spread strategies as well. Now, the consideration for the option writer is of course, the establishment of a directional bias by identifying a trend. So in other words, we don't want to be necessarily writing put options if the trend of a particular pair is to the downside. So we can establish a trend and then ultimately write options that have a high probability of expiring worthless by just identifying whether or not there's a high probability that the stock is, or sorry, that the pair value is going to be above or below a specific support level or resistance level. So again, these support and resistance levels that we identify give us sort of benchmarks for option writing, and I'm going to give you some examples as we move forward as well, just so you can get a better perspective as to what I'm talking about. Also, the idea of strike price selection for credit spreads. So, looking at being the options writer and then finding an appropriate set of strike prices that we can utilize that give us a more high probable trade success. So let's take a look at it at just the simple concept of trend identification. We recognize that the definition of a trend is really simply what direction a market is going. So we can identify a trend in the equities market, in the commodities market, or in the currencies market. And what really we're looking at is the fact that a market never moves in a straight line. But if we can actually identify, and I use the term peaks and troughs because it's sort of just a very simple way to illustrate my point. But if we can really just look at what direction the peaks and the troughs are going in, well, then that helps us identify the overall trend and allows us to stay with it in order to profit, or to really identify a change so we can lock in profits or perhaps take advantage of a new opportunity. Now, what is great about the options market is that not only can we profit from an uptrend, we can profit from a downtrend, but we can also profit from a sideways trend. So in other words, if we see a particular pair consolidating within a certain range, well, then we could take advantage of strategies where we're option writers, again, above and below support and resistance levels, or strategies such as iron condors, where we're creating call credit spreads above a resistance level, put credit spreads below a certain support level. So in other words, we can take a quick look at a price chart, identify what the overall trend characteristics are, and then determine what the most appropriate option strategy might be to take advantage of. So it's really the idea that we're sort of considering that a picture is truly worth 1,000 words, and we're able to generate a lot of information off of just one quick analysis of a price chart. So there's really some simple rules of thumb that we try to reinforce when it comes to identifying a trend, and these may sound very juvenile, but the bottom line is they make a lot of sense when you're actually analyzing a chart. The idea is that an uptrend will make higher highs and higher lows, and subsequently a downtrend will make lower highs and lower lows. And we're going to use these peaks and these troughs to draw a trend line. And the idea is that, let's say, for example, we're looking at the BPX here, which is the U.S. dollar versus the British pound. Now, this is a snapshot leading into the first of the year. You can see back back January. Let me just find my little arrow here. You can see that the price chart here is sort of stops here at January. And the idea, though, is that we can look at this pivot point here, this pivot point here, and this pivot point here, and we can really establish, based on those pivot points, an uptrend that is in place. Now, we can notice that in and around the 18th of January, we had a break of that trend line, and the first sign of a change in direction is essentially a break of a trend line. And in fact, we can also look at this pivot point in here as well as another sign that the current trend that was in place is actually coming under some pressure. So that observation right in there gives us some sort of an inclination that perhaps the trend that was in place is actually starting to change, because we're no longer making higher highs, as you can see here, higher here, higher here. We're now in higher lows. We're starting actually to make lower highs, and now here we have a lower low. So the consideration would be, if we've been profiting from a move to the upside and we're starting to see changes in that respect, well, then ultimately what we may want to do is we want to lock in our profits. So if we bought calls down here, we may want to consider selling off those calls to lock in our profits. if we're looking at a possible opportunity, then what we can do is we can look at that first, the break of the trend line, second, the break of that pivot point, as an indication that it might be an appropriate time to buy put options, and then ideally we can capitalize on a move that trends to the downside. And of course, here we have essentially what was happening based on this morning's trade observations. But what we've done here, as you can see, is we've just simply, in this example here, identified a couple of key pivot points that allowed us to create a benchmark from which we can take action from. Now, the next example here would be the identification of a downtrend, and so here we have a snapshot of the euro. This is the EUI, so this is the U.S. dollar versus the euro. Sorry, that should read EUR, not EUI. And again, we can notice here that we have a trend line in place, and all along for the last several months, we've seen the U.S. dollar selling off against the euro, and we've seen the euro, in fact, strengthening against the dollar. And you can see that on a number of occasions we've seen these tests of this very well-defined trend line that have suggested to us that the path of least resistance is to the downside, and that the consideration is that until we see technical evidence suggesting otherwise, the U.S. dollar is weakening against the euro. Well, just over the last month or so, we've actually seen a change in direction. Now, of course, you can see this little blip right in here. This actually indicates where the market opened, where the U.S. dollar opened this morning. And again, that was essentially based on the what happened coming out of Europe, and the idea that perhaps there might be another bailout in the works for Greece, and that Germany was kind of stepping back a little bit on their stance on looking to perhaps bail out of the euro as well, and that brought a little bit of strength into the euro, and it brought weakness into the U.S. dollar. But what you can see here is that we had a major trend line broken. And although we had a significant drop today, we have to now step back and reevaluate and determine whether or not, this is the end of a new uptrend that was in place, or perhaps the start of a new opportunity to the downside. But the consideration leading into this break here, which took place the first week of May, was that we can stay positioned in a bearish stance on the U.S. dollar. So in other words, if we could buy puts on that U.S. dollar, and we could look to capitalize on those puts by just watching how it's respecting the downtrend. And then ultimately, when we see a break of that trend, we know that there is a change in direction, and that it may very well be an appropriate time to lock in our profits. Now, the thing about utilizing a trend line is that they're not very liquid, in the sense that obviously there are significant price fluctuations on a day-to-day basis, and today was one of those days where we saw very significant sell-off on the euro, on the U.S. dollar, and so our chart here is showing a nice little gap based on where it opened up this morning. So what we can actually do is we can add what's known as a moving average in place. Now, this is a snapshot of the CDD. This is the U.S. dollar versus the Canadian dollar, as seen here in the pair value CDD. And what I did is I just took the same chart. This is a daily chart, and I added an 8-bar and a 21-bar moving average. And so, just to give you an idea what these moving averages do, is rather than us taking a trend line, which is really the old-fashioned way of doing things, what we do is we take a moving average, and these are exponential moving averages, which are very, very common technical indicators that you can apply to your price charts through any broker. So anywhere where you're accessing your charts, 99.9% of the time they'll allow you to add a moving average. Now, I have a 21-bar moving average plotted in red. And that 21-bar moving average is, in fact, calculating the last 21 days, because this is a daily chart, of price action, and it's plotting a line. And so rather than us being sort of subjected to the day-to-day whipsaws of the CDD and not sure whether we're coming or going with respect to the trend, we can see here that on a number of occasions we saw the price action break above the 21-bar moving average, but for the most part, the trend has been to the downside. Now, what we do in order to help identify a change in direction is we add a shorter-term moving average, which is an 8-bar moving average. And this technique is a simple technique known as a double moving average crossover. And for people that are not, that don't want to spend a lot of time focusing on their price charts, and you don't want to be too elaborate with your analysis, the moving average, the double moving average crossover, becomes a very, very simple technique that you can utilize to establish a change in direction for a particular pair value. So what we have here is, you'll notice that the CDD was trending to the downside. You saw that our 8-bar moving average was below our 21-bar. Even though the price action, the pair value action broke above, our moving averages never crossed. You can see that as we move forward. You can see here, even though we saw the price action move above, they actually just touched but never crossed. It brings us to the latest area here, again, down the first week of May. You can see that we have a very well-defined moving average crossover, and in fact, the pair value has been respecting the 8-bar moving average quite closely for the last several days. Now, this morning, there was a very significant sell-off in the U.S. dollar against the Canadian dollar. So in fact, we actually saw and you can see here by this little glitch in the screen here, we actually saw a gap down to test this moving average. Now, if we're looking at this particular chart and we're looking at the things from a very near-term perspective, well, then all we're going to be hearing on the news is, wow, huge sell-off for the U.S. dollar against the Canadian dollar, and what does this mean? Is this a complete reversal in trend? But by putting these moving averages in place, we recognize that 21-bar moving average actually is a more or less a support line. And so what we want to be looking for today is whether or not today's price action closes below that 21-bar moving average, or whether that 21-bar moving average actually holds as support. So let's say, for example, we bought calls on the CDD all the way down here, and we're looking to capitalize on a strengthening U.S. dollar against the Canadian dollar. Well, we've obviously been subjected to some significant price fluctuations or pair value fluctuations, and so today's no different, other than the fact that it just happened in a very short period of time. By adding these moving averages, what we're able to do is we're able to step back and say, yeah, okay, fairly significant move here, but let's just see how that information is digested, and as long as the pair value finds support above these moving averages here, well, then we'll continue to look for a continuation to the upside. If we get a close below the moving average here, so in other words, we had a red candle that comes through and closes off below that, well, now we can step back and say perhaps it's time to reevaluate the trend. If we've been profiting from call options lately, perhaps it's an opportunity that we take some profits and conceivably on the other side of it look at perhaps purchasing some put options. I'm going to talk about how we can set up some trade entry ideas here in a couple of minutes, but you can see here how our moving averages just become a very comfortable way of observing the trend that's in force without being subjected to the day-to-day roller coaster ride that the pair value action seems to take us on. When in the absence of any other indicators. And just an important consideration for your moving averages as well. As I mentioned, I have on here my 8-bar and 21-bar moving averages, and 8-bar is blue, 21-bar is in red. But understand that if you want to get an outlook from a bigger picture perspective, so let's say you're not so much, I would say, let me just kind of rephrase that. The 8 and 21 bar moving average is a comfortable time frame for me because I'm looking at relatively short-term trade outlook. So I'm really looking at positioning myself for a few days to a few weeks to perhaps even a month with a particular opportunity. But if you're somebody that is a little bit has a little bit of a bigger picture outlook, well then what you can do is you could perhaps adjust this to let's say a 20 and a 30 or a 30 and a 50 to give you a little bigger picture outlook on the trend. And with that in mind, that simply means that the price fluctuations or the pair value fluctuations that you're going to see, and that you're going to have to withstand in order to stay with a trend are going to be that much more significant because you're calculating a wider scope of prices. So when we look at this concept here, as I mentioned, I just wanted to indicate once again the importance of utilizing that moving average as a little bit of a support level for a possible bounce for the U.S. dollar over the next couple of days. But if we get that close below, that's going to indicate a possible continuation to the downside.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.